Okay, what's up, guys? Back again for another episode of Stock Watch List. Yeah, so we have done several episodes, countless episodes already, more to come. Right now I'm currently just looking at, different stocks that I've either purchased or planning to buy, in future, maybe future quarters, I'll be looking, or even months, I'll be going back and running through how successful my stocks have been, whether they have been successful, whether they have been growing, or whether they are, faltering and just not doing well. So yeah, so for today's episode, we'll be looking at ChargePoint Holdings, ticket symbol CHPT. Let's get right into it. So ChargePoint Holdings is provides electrical vehicle charging networks and charging solutions in the US. It offers a portfolio of hardware, software, and services for commercial, fleet, and residential customers. So the company was founded back in 2017 and is headquartered in California. So that's about the company, a brief description about it. So moving on, we'll be looking at financials. Now I'll be adding financials and looking at how well the company has been doing over the years, to get a better idea of, you know, um, whether this stock is worth investing, in the next upcoming years as well. Yeah, so the financials, we can look at it and you know, since 2018 to 2021, actually it's been growing quite a bit, from the around that $60 million mark in 2018 currently until 2021, currently sitting at slightly under the $150 a million dollar mark. So roughly, nearly three times growth for its revenue. Again, like always, have to bring back the point that there was COVID and we are recovering quite well at this point, so yeah, so it's from 2020 to 2021, it's relatively, quite stable at that just under the $150 million range. So yeah, they're doing quite well. And for earnings, it actually gone down in terms of it actually went as how much revenue went up in terms of their earnings, they went down. And yeah, currently at that net loss of 150 million. So what does this mean? What's the difference between revenue and earnings? So revenue is the income a company generates before deducting expenses, and and on the other hand, earnings represent the profit a company has earned. It is calculated by subtracting expenses, interest, and taxes from revenue. So you can roughly see the difference between revenue and earnings. Most of us might not understand the actual differences. We might actually be assuming that both are the same thing. So here is a good description on the difference between revenue and earnings. So moving on, we'll be looking at the recommended trends, recommended rating, and what analysts have been saying about it, as well as their price target for this stock. So recommendation trends is, since July till now, yeah, July till now. So the month of July, August, it is honestly at that buy to strong buy range. Uh, you know, uh, Very literally nothing up on recommending to sell or is underperforming. So mostly analysts are targeting that buy to strong buy range for this stock. And in terms of recommendation rating, it is that buy which you can expect when you look at the trend of the recommendation trend. So currently sitting at the buy mark, which is good if you're planning to invest in this stock, like me. So analyst price targets right now, it's currently in that $20 region as a stock price. Its lowest point is 24, average 34, and highest 46. So right now it's severely under its lowest point, and that's quite interesting if you think about it. And if you think about the potential it has to grow for this company. So as always, we'll be looking at its 1 year stock profile first, and when you look at this 1 year stock profile, we can see it has it took it wa- it actually had its biggest growth in this period of I think it's around the December Jan period. Yeah, that's where it had the biggest growth. Where it hit that 40, $49 range, the 52-week range. Yeah, so that $49 to $50 price range, and since then it went downhill around the month of March, and right now it's stagnating at that 20 to $25 region. So for the past 6 months, honestly, it had again, these are volatile stock, so it went up, down, up, down, up, down, you know, and currently stabilizing at that $20 to $25 price range since the month of, July, August to September. So its biggest peak for the past 6 months was during the June period where it hit a price target of nearly $35, I would guess, and it went downhill and currently sitting at the $20 price range. So it took a steep decrease about $15. So yeah, again, as always, a stock that has potential and is in a downward movement, you want to keep an eye on that because you want to purchase any stock with potential at its lowest point. So in the past 1 month, it has relatively been in the range of, I mean, currently it is honestly at its lowest point, the $20 price range, and its peak was around the $23 mark. So it wasn't such a huge, difference in terms of um, the difference in value from its peak to its lowest point within a month. It's not such a huge difference, but you can relatively see that it's also not stagnant. It's also not comfortably sitting at a general what do you call that, straight horizontal line. It actually has this upwards movement, downwards movement, and yeah, so very interesting stock here. So as always, we'll be looking at the articles of what analysts have been saying about this stock and whether it's a potential buy, of course. So the first article's heading is that these three renewable energy stocks should benefit from a new infrastructure bill. So this article was published on the 16th of September. And yeah, let's look at this. So Congress is moving closer to passing a $1 trillion infrastructure package, and it's possible a multi-trillion dollar package will follow close behind. For investors, this could be a windfall, particularly for companies in the renewable alternative energy field. So funding will be widespread in renewable energy. So when three of our contributors were asked for their top renewable energy stock to benefit from the infrastructure package, the answers widely varied. But so these three are the focus renewable energy stocks that they're looking at, and ChargePoint is one of it. So ChargePoint made it to the top of this list. I mean, these three made it to the top, and ChargePoint is around that top three region of this list because they all could have huge tailwinds behind them. So they all believe there's potential in these three main renewable energy stocks. And of course, when you think about investing $1 trillion, uh, you know, you can see where ChargePoint is going to grow from. So a needed jolt to kickstart what could be years of monster growth. So electric vehicle charging infrastructure company ChargePoint reported its second quarter fiscal year 2022 results on September 1. Despite popping 8% the next day, the stock is still down 45% for the year at the time of this writing. So the main culprit for this is the downward pressure. For the downward pressure could be the company's inability to live up to growth expectations. So currently their growth expectation is not too good, and that's why there's been a slight struggle in terms of how ChargePoint is looked at as a stock. So, but it could also be the simple fact that the pure play EV charging industry will need time to grow into the industry the market hopes it can become. EV market, Tesla, all these like this com this renewable energy stock market, companies involved in renewable energy, it's going to grow when more and more bigger companies start utilizing the renewable energy available from these companies. So it's a big market play, but currently not being aggressively looked at by those other companies. So North America's market leader in EV charging, ChargePoint is well positioned to take advantage of increased EV adoption. The company's entrenched position in level 2 charging, added influence in Europe, and growing subscription business are all reasons to like the company long term. Again, long term focus, great. However, management has been honest about the importance of Congress passing a favorable US infrastructure bill. So it's still dependent on Congress and whether they are able to, pass the US infrastructure bill. So yeah, moving on. Excitement for public spending and ongoing private investment in charging bodes well for ChargePoint's future. But with just 146 million in fiscal year 2021 sales, ChargePoint stock is currently trading at a nosebleed price to sales ratio of 48. That is quite poor. However, the company is confident that its growth rate will begin to take off in the coming years. So again, potential, they're seeing growth coming in the future years, future quarters. So ChargePoint's freshly updated forecast from September 1 calls for 2022 revenue of 225 million to 235 million. So that is about, you know, $80 million increment from 2021 sales. Yeah, the midpoint of which will represent a 57% increase over 2021 sales. From there, the company thinks it can grow revenue to nearly 1 billion by fiscal 2024. So they are looking at a long-term play here. This stock is mostly a long-term play. You can't be looking at this stock, thinking that, oh, we are going to get short-term profits and it's a short-term play. It's just never going to happen because it's a renewable energy company. It it has potential the longer it goes on for. So yeah, so ChargePoint is undoubtedly a very high risk, high reward EV infrastructure stock. When you see high risk, high reward stock, you always want to go into the play at its lowest point. Right now, it's a good time to go into this play because it is at that low point, and that's when you actually want to start racking up these stocks in your portfolio. So an infrastructure bill would be a big boost for ChargePoint and increase its chances of living up to the hype. A boost for companies building energy infrastructure. What each of these companies has in common is that they are building products that are foundational to more renewable energy use. Transmission lines, EV chargers, and buses may not get a lot of headlines, but they are foundational to a cleaner energy future. People want to people are looking at net zero carbon, renewable energy. They want to, what do you call it? They want to reduce carbon emissions and all this bad pollution, to our planet. So, so more and more companies will be focusing on how to bring about renewable energy, how to make a cleaner world. And and to be honest, it will take years for that to happen, but every year there would be progression, and this company is definitely part of that progression. So key points here is that public support for EV infrastructure bodes well for ChargePoint. So the next article I'll be looking at is three top electric vehicle stocks to buy now, and this article was published back in 18 September, the Motley Fool. So the Motley Fool issues rare all-in buy alert. So why is that so? Despite optimism for a Biden infrastructure bill that supports electric vehicles, many automakers have seen their share prices struggle as of late. Traditional automakers including Toyota, General Motors, and luxury brands like Lamborghini and Porsche have unveiled bold plans to integrate zero-emission vehicles into their lineups. Whether it's automakers, suppliers, basic materials companies, or other businesses investing in the EV industry, can be challenging and confusing. So these three stocks that stand out from the crowd are, and one of each ChargePoint. So here's what makes each a great buy. So be looking at ChargePoint, focusing on that. So the balance play here is Ford and Lucid have exciting EVs aimed at disrupting their respective markets. Even with their advantages, competition should continue to get stiffer as the EV industry matures. ChargePoint, on the other hand, ChargePoint stock offers a way to invest in increased EV adoption in North America and Europe without having to stake your claim in a particular automaker. That's very important. That is the difference between, the three companies here we are looking at. The company has a charging network of 118,000 active ports and was adding over 65 new ports per day in its most recent quarter. It will also integrate around 40,000 new ports in Europe after it completes the acquisition of Has2Be e-mobility, an EV charging company with a leading position in Germany, Austria, and Switzerland. So right now their focus is getting into countries within the North American and the European region, two hot regions when it comes to EV cars, when it comes to, promoting renewable energy, net zero carbon emission, two heavy continents that can influence the growth of company, worldwide. So ChargePoint typically generates over two-thirds of its revenue from its commercial segment, which tends to be business looking to offer charging to their employees or customers. So ChargePoint doesn't actually make money off the electricity used at its ports. Rather, it makes money from providing the hardware and servicing for those stations through support and subscription. So this is interesting. So they don't actually make money from, the electricity bill or the the consumption of electricity by people who use it. They actually build they're actually getting money from, the servicing and the subscriptions of of those of the hardware and the ports, of course. So for the time being, hardware makes up the majority of revenue, 73% in the second quarter of 2022. However, subscriptions to various ChargePoint services are expected to provide a higher percentage of revenue over time. ChargePoint has been expanding its service offerings, which it refers to as its cloud service solutions, but in reality, these are basically just added features like power management software, pricing control, blah blah blah, to and more that can increase the revenue generated per charging station. With a market cap of around 7 billion and forecasted fiscal year 2022 sales of 230 million, like the previous article, what they said as well, ChargePoint has a whopping forward price to sales ratio of 30, giving it an extremely lofty valuation for an unprofitable company. So that's quite interesting to have, such a high valuation when the company is not profiting well. That's quite interesting. But there's reason to believe that it can grow into its valuation over time, and that's where the lofty, valuation comes into play, the potential, the growth in the coming years. As EV adoption grows in North America and Europe, ChargePoint could be a growth stock that is worth the risk for investors looking for a catch-all way to invest in EV infrastructure. So the key point here is that ChargePoint Holdings continues to expand its infrastructure in lockstep with increased EV adoption. So the last article we'll be looking at is got $2,000. Here are two beaten down growth stocks to buy right now. Published 20 September, the Motley Fool. If an investment in a growth stock works out, you only need to allocate a small amount. If it doesn't, you would only have to have risked a small amount. If you're seeking growth and have 2,000 of investable cash looking for a home right now, beaten down names shift the risk reward more in your favor. Growth stocks are typically volatile, giving investors more chance to buy the dip without waiting for a general market downturn. Investors should look at these two names from different sectors that are significantly underperforming both the S&P 500 and the more growth-oriented Nasdaq Composite indexes. So ChargePoint, ready to drive forward. Another growth stock that has seen its shares discounted in 2021 is EV charging network ChargePoint. The company operates in a crowded field. Many investors bought in with promises of exponential growth ahead. Some of these companies aren't living up to expectations, and the entire sector is well off share price levels seen at the peaks over the last year. But ChargePoint has a long history and has shown recent progress towards its growth goals. The company has been in business for about 14 years, and it says that over 3 billion electric miles have been driven on its charging network. So it also believes that it's just the beginning. Prior to going public earlier this year, ChargePoint told prospective investors it believed its revenue growth would accelerate from about 135 million to 1 billion in in the next 4 years. That's huge growth. That is literally huge growth because when you're thinking about ChargePoint, you're looking at a long-term play, and when you can see that much growth in the next coming 4 years, this stock price is definitely not going to stay at this $20 range, or even $30 range. It is definitely going to, you know, double or maybe even triple in the next 3-4 years. So yeah, uh, in its second quarter fiscal 2022 update, the company included a 15% boost to its calendar year's revenue guidance at the midpoint of the range. That's a good start to its public life, but the stock is still down almost 50% year to date. A ChargePoint network account gives customers access to more than 130,000 places in North America and Europe in which to charge their EVs. So it is the leading North American level 2 charging network which uses 240 volt power. It also has more than 2,000 publicly available fast charging stations and is growing its network in European countries. So like again, they're focusing on two main continents, which is the North American and European continents. So, but even with the stock down this year, ChargePoint still trades at high levels. The company hasn't yet produced profits, and it trades at a price to sales ratio of 29 based on the new 2021 sales guidance. But for someone looking to put some cash in a speculative investment in a growing sector, ChargePoint shares come at a discount compared to their price at the start of the year. Like I said, this is the best time to get in this stock game for ChargePoint. When you see potential in a stock, you want to buy it when it's at this lowest dip, when it's literally at the bottom of the bottom. And right now, $20, it's a huge discount and it's a huge how to say undervaluation of what their stock could become. So the key point here is that ChargePoint in the high growth EV sector is down 50% year to date. But again, we are buying this for the long term play, in 2 years, 3 years, 4 years time to reap its actual rewards. So as always, final part we'll be looking at what people have to say, good things, bad things. I only can fit some in here. So I'll be mainly focusing on, the good signals that potential investors are getting from this company and what they are seeing. And if you're interested in actually reading up more on the comments, you can view it on Yahoo Finance, of course. But here are just some of what you know people are saying, or even potential investors of ChargePoint are saying. So Charlie is saying that stock will be back at $26 very soon. It's undervalued. Ignore the haters on the board. If they're shorting this at 2021 dollars, they had lost their mind. There are so many other stocks which are far better shorters than this. For example, AFRM, for example, last Friday's jump to 126 was a little too overreacted. It was a clear sign for a 10-15 bucks drop, but no, they are shorting ChargePoint for a buck or two drop and spam here all weekend. So he believes that the stock has potential to go back to where it once was, because right now he believes that it's undervalued, like what I also believe right now. $21, it's a really good buy right now because it won't be around this range, anytime soon. So Jen is saying whole market is down today. Not only ChargePoint, just stay out of the kitchen if you can't stand the heat. Take a walk, drink a beer, and come back next month. I feel like next month might be too late. That $21 price range might move up slightly, not too much, but you just never know with stocks. So Eric is saying best company strong support at $20 will be over $100 in the long run with the EV expansion strong buy. It could be in the $100 range, you know, but that takes time. 3-4 years later, maybe 4 years, 5 years later, then you could see the $100 price range, because this is a growing company, and it takes time for growing companies to reach you know uh, huge potentials like a $20 to $100 jump. That takes a ton of time, takes many years to get to that point. So Roy is saying millions of vehicles are coming to the market in the next several years. If you thought ChargePoint was part a short-term play, you were mistaken. This is definitely not a short-term play. If you're purchasing this for the short term, you shouldn't. There are many other better stocks to purchase for the short term. But if you're planning for a long term, just put your cash in, let it grow, let the stock just grow on its own. In 3 4 years time, this is definitely the play. So yeah, so basically most of the comments here right now are quite positive in terms of what they believe ChargePoint can grow to. They recognize that it's not a short-term play. They recognize that it's really down right now in terms of valuation, in terms of stock valuation, and that this might not be there much longer, and actually might grow in the next few quarters, and of course years to come. It's definitely going to continue growing. So yeah, so that's it for what I've got on ChargePoint. Like I said, I'm going to buy it at this price range, $20 price range. It's a sweet spot to actually buy this stock. I'm just going to keep it for the long run. I'm not going to buy it and start looking at it for short-term gains, because that's not going to happen. That's not likely. So yeah, this is a long-term play, 3 4 5 years. Just leave it there, and that's what I'm going to do. So yeah, so that would be the end of the video. And of course, as always, hit that thumbs up button, hit that subscription button, hit that notification bell to notify you of more videos. And like always, if you guys love the video, of course, hit the thumbs up button. But if you found this informative, let me know down there in the comment section. And yeah, so thank you guys, and goodbye.